As we step into 2025, tax laws and regulations are subject to change, which could have significant implications for your personal finances. Understanding how these adjustments will affect your income, deductions, and overall tax situation is crucial to managing your finances effectively. From changes in tax brackets and deductions to new credits and policies, staying informed can help you optimize your financial strategies and minimize your tax liabilities. In this video, we'll break down the key tax changes expected in 2025 and offer practical advice on how to adjust your financial planning to make the most of these changes. 1. New tax brackets and rates. What's changing? One of the most significant changes in the 2025 tax landscape is the potential adjustment of tax brackets. Tax brackets are periodically updated to account for inflation, and it's likely that the IRS will continue this practice in 2025. This means that the thresholds at which various tax rates apply could shift, leading to potential changes in how much you owe in taxes. Key updates. Bracket adjustments. Tax brackets will be adjusted for inflation, potentially shifting higher earners into different tax categories. For example, the threshold for the 24% tax bracket may rise, affecting those with middle-class to upper-middle-class incomes. Capital gains. Tax changes to capital gains. Tax rates, especially for high-income earners, may also be implemented in 2025. If you are an investor, it's essential to monitor any updates related to long-term capital gains taxes. Impact on your finances. Lower tax bills for some. If your income places you in a lower tax bracket after adjustments, you may find yourself paying less in taxes. Increased taxes for high earners. Higher earners may face a higher tax burden if they move into a higher tax bracket, or see an increase in capital gains taxes. How to adapt. Monitor income shifts. If you anticipate a change in your income or tax bracket, consider adjusting your withholding or making estimated tax payments to avoid any surprises. Maximize tax-advantaged accounts. Contributing to retirement accounts such as 401ks, IRAs, and HSAs can lower your taxable income and help you reduce your tax burden, especially if you are nearing the upper end of your current bracket. 2. Changes to deductions and credits. What's changing? Tax deductions and credits are another area where changes are expected in 2025. These adjustments could include an increase in the standard deduction, changes to itemized deductions, and the introduction of new credits. Key updates. Standard deduction. Increase. The standard deduction is likely to increase in 2025 to keep pace with inflation. This means that you may be able to deduct a larger amount from your taxable income, reducing the overall tax bill. Some itemized deductions could be eliminated or limited, such as state and local tax, SALT deductions, which have been capped in recent years. This could affect taxpayers in high-tax states. New tax credits. New credits may be introduced for specific expenses, such as childcare, education, or energy-efficient home improvements. Impact on your finances. Increased standard deduction. A larger standard deduction means you'll have more of your income exempt from taxes, which could result in lower taxes for many taxpayers. Reduced itemized deductions. If itemized deductions are reduced or eliminated, it could affect taxpayers who traditionally rely on these deductions to lower their taxable income. New credits. If new credits are introduced, you could benefit from additional tax savings, especially if you have qualifying expenses. How to adapt. Reevaluate your filing status. With an increase in the standard deduction, it may make more sense for some taxpayers to file as married filing jointly, or to reassess their filing status to maximize the deduction. Explore new tax credits. Stay informed about any new credits that may apply to you, such as energy-efficient home improvement credits or educational credits, which can reduce your tax bill. Review itemized deductions. If you typically itemize deductions, you may want to evaluate whether this remains advantageous in 2025. If the SALT deduction cap remains, for example, it may no longer make sense for you to itemize. 3. Retirement account contribution limits and tax benefits. What's changing? Retirement account contribution limits are likely to increase in 2025 due to inflation adjustments. These adjustments can help you save more for retirement while lowering your taxable income. The contribution limit for 401ks and similar employer-sponsored retirement accounts is expected to rise, potentially allowing you to contribute more to your retirement savings. Traditional IRA and Roth IRA contribution limits are also likely to increase. This could be particularly advantageous if you're looking to lower your taxable income in 2025, or if you're using a Roth IRA to take advantage of tax-free growth. With higher contribution limits, you can save more for retirement and reduce your taxable income, which could lower your tax bill for the year. If you contribute to a Roth IRA, you can benefit from tax-free growth, which is especially advantageous in a rising tax environment. If the contribution limits increase in 2025, aim to maximize your contributions to take full advantage of the tax benefits. The more you contribute, the more you can reduce your taxable income. Consider Roth conversions. If you're nearing retirement and tax rates are expected to rise, while you'll pay taxes on the conversion, you'll benefit from tax-free withdrawals in retirement. 4. Changes to healthcare and medical expenses. What's changing? Healthcare expenses, including premiums, deductibles, and other related costs, may see changes in 2025 that could impact your tax situation. Contribution limits for HSAs may increase, allowing you to save more for healthcare expenses while reducing your taxable income. The threshold for deducting medical expenses may be adjusted, allowing more people to deduct their medical costs if they exceed a certain percentage of their income. If you're eligible for an HSA, you can contribute more to your account in 2025, which could provide substantial tax savings if you're using it for qualified medical expenses. Adjustments to the medical expense deduction threshold could benefit those with high medical costs, allowing them to write off a larger portion of their expenses. How to adapt? Contribute to an HSA. If you have a high-deductible health plan, HDHP, maximize your HSA contributions to reduce your taxable income and save for future healthcare costs. Track medical expenses. If the medical expense deduction threshold is lowered, keep detailed records of any medical expenses you incur. If they exceed the new threshold, you could qualify for additional tax savings. Be sure to take advantage of all available deductions, including those for business expenses if you're self-employed, to lower your tax liability. Tax changes in 2025 will undoubtedly affect your finances, but by staying informed and adapting your financial strategies, you can navigate these changes with confidence. Whether it's adjusting your withholding, maximizing retirement account contributions, or taking advantage of new tax credits, being proactive about your taxes will help you minimize your liabilities and ensure your financial success in the year ahead. Always consider consulting a tax professional for personalized advice tailored to your specific situation.